Today, the Reserve Bank of New Zealand cut the OCR by 0.5%. We're now down to 2.5% on the OCR. The OCR stands for the official cash rate, and this is the primary mechanism by which the Reserve Bank of New Zealand, the central bank, influences the cost of money or interest rates. This flows through basically to floating interest rates and short-term fixed interest rates. In this short one, I'm going to cover the current state of play in the economy. I'm going to share my crystal ball a little bit, and I'm going to share and speculate what I think it all means for house prices in 2026. Now, if you don't know me, my name is Darcy Ongaro. I'm a qualified financial advisor, and I work with everyday people who are prepping for and entering into some of the best years of their life. I talk a lot about property and all things investing on this channel, especially from a New Zealand context. So if you like this sort of thing, please be sure to like and subscribe. Let's get started. So the OCR, the official cash rate, was cut today. And before we get into what it all means, let's talk about the current economic reality. GDP, or gross domestic product, which is a very imperfect way to measure the performance of an economy, well, that dropped by 0.9% in the second quarter of 2025. Like I say, it's not a perfect measure of economic performance. Probably a better indicator would be the number of shoes at open homes, the number of for sale signs that you can see lingering, and the number of closed for business signs that you see when you walk down Main Street. But either way, we know that the numbers don't look good. The unemployment rate, again, it's not a perfect indicator of the real state of play. That's now at 5.3%. That's the highest in 9 years. Business confidence continues to decline despite a little bit of optimism that we received in August with the latest monetary policy statement, which indicated there was going to be more aggressive interest rate reductions in the future. We are in recession. There's no way to sugarcoat it, and we shouldn't. We need to be honest with where we're at. Otherwise, it's going to be really difficult climbing out of the hole that we're in. Businesses are failing. Households are being forced to cut back in really important things, and sometimes people are being forced to sell their properties at a loss just to get through. What's worse is that the Reserve Bank of New Zealand is trying to manage things by looking in the rear view mirror. They're just playing catch up. Here's what my crystal ball says. My view is that the Reserve Bank of New Zealand will probably be forced to cut another 1 to 1.5% even off of the OCR from here. That'll mean that interest rates will potentially hit around that 1.25% on the OCR this time next year. We could actually see mortgage rates for the 1 year fixed rate hovering around that low 3% mark or even below the 3% mark. So my view is that they will cut deeper with egg on their face, to be honest. I should also mention that the effects of today's interest rate cuts or today's cut on the OCR has largely already been factored in with banks. Banks have been cautiously dialing down the interest rates, and they may make some more adjustments in light of what's occurring today. But even that won't hit the economy right away because typically people will be still fixed for about 3 to 6 months. And that means that there'll be a bit of a delay before the stimulatory effects of the reduction in interest rates actually flow through to real life. Now, I'm not too focused, by the way, on what the Reserve Bank of New Zealand should do. There are plenty of other economists, especially, that will opine on that till the cows come home. I'm more focused on what the Reserve Bank of New Zealand will do. I consider things like the rising unemployment rate that we've seen and the rate at which that's increasing. I'm thinking about AI-induced unemployment, which everybody's worried about, everybody's thinking about and talking about, but nobody's really measuring yet at this stage. And I'm thinking about the business failures. I know of accountants that are dealing a lot with insolvencies. I'm seeing a lot of boarded up businesses and people shutting down, closed for business. It's kind of like one of the things that you check right now before doing business with anybody is, are they actually still in business? That's generally not a good sign. And traditionally, a lot of people will go to the government, either to the left or to the right, to place hope in them to make things better. And short of reducing the size of government, reducing their tax take, which is kind of, let's be honest, it's kind of hard to imagine that they will ever do that. The only other viable option is that the government will step back a little bit and create space for the central bank to move in and take that load off of their shoulders, make the cost of money cheaper. That indirectly injects more currency into the economy, which wallpapers over all the cracks. Totally not perfect, but that's what I think they will end up doing. As it relates to what this means for housing, I think this is really important because whether you have a property or whether you don't have a property, you probably care about what happens with housing or house prices. In New Zealand, property is a currency conduit. We're not really good at talking about this in the financial services industry, in my view, but we do heavily rely on the Reserve Bank of New Zealand to goose house prices, basically. And the way it works with housing is that it is the conduit, it is the mechanism by which new currency enters into the economy. Because as house prices rise, people need to borrow more money over time, which then goes through to the sellers of that property, which then goes through to renovations, to economic expansion, business expansion, hiring people. It all happens through property. And if property prices don't increase, then it doesn't occur. How do we get property prices to increase? Despite what the government says, that's what they want. They have to lower the cost of money. Our wages, our income doesn't increase at a pace which is fast enough. So the only other pressure relief valve is to lower interest rates. And as a property owner, myself, and this is probably true for you also, on one hand, you do want prices to rise. You want your net worth to rise, let's be honest. But on the other hand, you don't really want to see everyday Kiwis suffer because they can't get into housing themselves. And this is just one of those imperfect realities with how the system works. We're not a housing market with an economy driving it. We're an economy with a housing market bolted onto it. So when interest rates drop dramatically, that money will flow straight through to property first in the form of increased buyer demand. That then creates a feedback loop, and we all start feeling more optimistic. The problem is that we could see another housing boom. Well, let's put it this way: we will see another housing boom. However, we might see that boom occur within a period of stagflation. This means that we might see economic activity stagnate for much longer than what a housing recovery does. And we might see this still occur within a period of inflation, partly because of the systemic inflation that we have isn't something that we can stamp out easily with monetary policy. Most of it is imported from overseas. So, rising prices when the economy goes south sounds mad, right? But it's exactly what happens when you flood the system with cheap money as a shortcut way to jumpstart things in the future. Property becomes the inflation hedge, therefore, when everything else looks grim. So, one of the reasons why I've been saying all year so far, now is the time to buy property. If you're worried about being on the receiving end of inflation, then get on the positive side of inflation by taking ground when there's blood on the streets, even if some of that's your own. Now, what about the new governor? I keep on thinking it should be called governess, but the new Reserve Bank of New Zealand's governor, Anna Bremen. She takes over in December 1st of this year. Now, what is the Swedish central bank's track record? Well, they're moderately dovish. What that means is that there's a little bit of a bias towards lowering interest rates. And she was like many central bankers at the time of March 2020, calling for much, much lower and almost zero interest rates. Um, she's a bit different in that she was probably a little bit critical of keeping them lower for longer. She also seems to demonstrate an ability to get ahead of the curve. Just looking at the OCR or their OCR equivalent in Sweden, compared to New Zealand's, looks like they went harder faster, which in my view would have been a much more appropriate stance for the Reserve Bank of New Zealand to take. So there is a little bit of hope that we might get a better result there. And it's hard to say whether or not that was taken into consideration with today's announcement. But we should also just mention the conduct and culture of the Reserve Bank of New Zealand. The RBNZ staff numbers jumped from 255 employees in 2018 to 641 employees by September of 2024. Yes, they're trying to get this reduced, but when you think about the wages that they're paying, from anywhere from $100,000 up to $800,000, as in the case of the new governor, it's a lot of money to spend, and is unclear as to whether we're actually getting quality results. Being one of New Zealand's largest growing employers in the face of a recession is not a recipe for rock star growth. Will Brennan be any different? Track record suggests she's competent, but still more or less conventional. The role itself might be a problem as well, not the person in it. It's the entity, it's the structure, it's the conduct and culture of that institution rather than the people that work there, in my view. The central banking playbook is the same everywhere as well. So it's not just a New Zealand thing. They react late, they overreact, and they blame external factors rather than accept responsibility themselves. So, where does this all leave us, right? Well, the OCR will go lower than anyone expects. The property market will boom, and it will boom regardless of the economic circumstances. So, even though it feels like property is dead and you're looking at your house price and nothing is changing yet, it will change. As sure as night follows day and day follows night, it will improve. We will see another all time high probably in the next 5 to 10 years. The other thing that we know for sure is that more Reserve Bank of New Zealand staff, it won't create better outcomes. So we should plan accordingly and we should invest according to a strategy that benefits from more currency hitting the system. Property, precious metals, and finite digital assets are great examples, as well as a traditional investment portfolio, great examples of how you can hedge against inflation caused by central banks. So, what this means for you? Well, when you're fixing your mortgage, just keep in mind that interest rates may continue to fall. Fixing for 6 months or 12 months, that feels about right. And in some cases, floating might be something to consider if you believe that a new person at the helm will increase the speed at which rates drop by. If you're a property investor, or if that's an area that you want to take ground in, like you want to upgrade properties, now is a really good time to take action. I'll say that until I'm blue in the face, perhaps, but it will not likely be any easier in the future. Let's put it that way. And so, if you are thinking about taking ground, I would get your ducks in a row and figure out a strategy to take ground now if you can. Lastly, don't wait for the Reserve Bank of New Zealand, the central bank, or the government to get it right. They probably won't. So take matters into your own hand and figure out an investment strategy which benefits from their mistakes and protects you from their mistakes at the same time. So keep your eyes on what they do, not on what they say. And if you would like to reach out for personalized financial advice to develop your own financial strategy, do feel free to reach out to me. Link is in the show notes. See you next time.